The banking sector has been one of the market's top performers in recent years, but second quarter profits weren't as strong, especially for the big three banks, leading to their recent share price weakness. Is this ongoing sell off a buying opportunity, or should investors brace for more bad news? Hi everyone, welcome to the Market Talk series of Intelligent Investing. I'm April Tan, Chief Equity Strategist of COL Financial. To help us understand what's happening, we have with us COL's Banking Analyst Charmaine Co, who will break down the trends in loan demand, net interest margins, and provisions that shaped banks' earnings in the first half of 2025. Thank you, Charmaine, for joining us in the show.
Of course.
Okay, so let me begin by asking you about the second quarter earnings. So the second quarter earnings of banks increased by 6.7%. So this was roughly the same as the first quarter. But I'm just curious, why do you think the performance was more disappointing? Because if we look at the performance of banks, the reaction of investors have been more negative in general.
Yeah, I think that's true. The reaction was definitely more negative for the bank's earnings in the second half. And then maybe it's also, well, my first thought would be that in the first quarter versus the second quarter, in the first quarter, results of the banks in general were much more in line with market expectations. Whereas in the second half, we actually saw more banks, like half of the banks under our coverage. I think 4 out of 8 were below expectations. And then on top of that, 2 were in line. So it was really only East West and PNB, which are smaller banks, that delivered results that were above expectations. So with the heavy hitters or the bigger players in the banking sector, like BDO and BPI in particular, were, their results were more disappointing to investors in the second half especially. So that could be the reason why.
Okay. So more dispersed. And then the bigger banks delivering more disappointing earnings in 2Q versus 1Q. Okay. So loan growth at 14% year on year. I'm just curious if all banks this time delivered double-digit loan growth. And what was the driver of loan growth? Is it corporate, the market, or consumer?
Well, in terms of loan growth, I think that maybe it's just PNB that delivered a single-digit loan growth. So everyone else did deliver like loan growth in the mid-teens, low to mid-teens. And loan growth it still continues to be broad-based, which is, I guess, a plus for the sector. Of course, the consumer loans are growing faster. Not only is it coming from a smaller base compared to the corporate loan segment, but the banks are also, I guess, pouring more resources into this segment now, since rates are coming down and we all know that consumer yields are higher. So I think across the sector, maybe we were seeing consumer loan growth mid-teens and up, whereas corporate loan growth, it was in the mid to high single digits. Of course, it was also more varied, the number across banks, because some banks are more focused on, or I guess they're more selective when it comes to corporate loans and more focused on growing their consumer loan book. From the bigger banks or the bigger players in the corporate loan space, I think that their loan growth was in near 10% or above 10%.
Okay, so now let's talk about the net interest margins. So we saw that improving, and this is despite the BSP cutting rates by quite a lot compared to last year. I think it's by June it was 125 basis points. So I'm just curious, like what allowed the banks to improve the net interest margins despite the rate cuts, and what's your outlook going forward the next 12 months? Should we see NIMs actually going down or improving or staying flat?
So on the net interest margin of the bank, I think, well, this is maybe not that great of an answer, but it depends per bank, because I guess the nature of their balance sheet or the loan mix and the deposit mix, it's all different from each other. So to start with, we can think of net interest margin, right, as asset yield and funding cost. So asset yield being the interest rate that the banks earn on loans and government securities, and then funding cost as the cost that they pay, the interest rate that they pay for deposits, bills, and the bonds that they have to fund their assets. So, parang to keep the NIM steady, it would mean that either they're both
Going
asset
down.
yield and funding costs stay flat, they're going down at the same rate. Or maybe if NIM is improving even, like we see in some banks, then funding cost is going down much quicker
Yeah.
than asset yield. And both of these move naman with the rate cuts. That's how we can say that their general direction, I think I would expect that's trending downwards over the next 12 months. But then to discuss what factors are in particular would help them maintain their margins, I think to start with, it would have to be the reduction in their reserve requirements. So it helped with their funding costs, on the funding cost side a lot, since it freed up deposits that weren't being used before to earn money for the banks. And then apart from that, also in terms of the mix of the loans, so most of the banks now, the proportion of consumer loans to total loans in their portfolio, it's increased a lot from when the rate hikes began. So having a higher number or having
Exposure,
higher exposure to consumer loans, it gives them better yield, and more importantly, the yield for consumer loans is also stickier. So it can help them keep asset yield higher for longer, even as their other loans are repricing downwards with the rate.
Yeah. Yeah. So I think from last year, like the BSP has cut reserve requirements by quite a bit, right?
Yeah. I think by maybe 9
percentage.
5.
So from 9.5 to 5%. So
Something like
that's
yeah.
450
Yeah.
basis points, no? So that really freed up a lot of liquidity for the banks. And then consumer lending, like I think it's been growing by double digits talaga for a very long time. So of course the share is now like a lot bigger for the banks, I think in general. Which of course the rates on consumer loans don't go down a lot, even with lower interest rates. Okay. And I think one of the factors that pulled down the earnings, because earlier on we talked about loans still up double digit, plus NIMs steady to up. But I think one of the major factors really is provisions. Provisions nearly doubled this quarter. So what caused the spike in the provisions? And is this something that investors should be worried about?
So that's right. That I think the miss in the bank's earnings was mostly due to higher than expected provisions. As to the reason why provisions have increased so much, it also differs per bank, the reason as to the increase in provisioning. For some banks, it's just normal business as usual. As they grow their loan book, especially the consumer portfolio, then they have to preemptively set more
aside,
provisions, to build up their credit buffer for expected losses. And then on the other side, there are some banks maybe that are the consumer banks, I think, specifically are building larger, relatively larger, because they have new to bank or new to credit customers that they need. I guess they need to provision more before, since they haven't gotten to know the client or their payment behavior as well. Especially because the consumer loan segment that's growing the quickest is unsecured.
Yeah. And like I remember looking at your models. I think last year the provisions went down a lot.
Yes.
So also we have that base effect going on, like low base, because during the pandemic the bank set aside a lot. And then they decided last year, we're not going to set aside as much because we have a lot of it. And now they're going back to normal.
Yeah.
Plus, as you said, greater exposure to consumer loans. So higher provisions. So I think a combination of all those factors. But just curious about your thoughts on NPLs. I mean, are you seeing a deterioration in asset quality that is worrisome in the NPL ratio?
In terms of the NPL ratio and the asset quality of the banks, actually, I'm not to the level of worried yet. More just watching out for signs. Since I guess you can think of provisions versus NPL ratio. NPL ratio is like it tells you the current health of the loan book, right? While provisions is more, I guess, forward looking, or it's a preemptive buffer that they're building up for the future. So since even if provisions are increasing, since the NPL ratio has stayed relatively stable, actually I also checked this just a while ago. The past due ratio of the sector, this is based on BSP data. The past due ratio has also stayed relatively stable since January to like the most
Year to date.
the year to date data.
Yeah.
So that tells me that there's not much to worry about yet on the credit quality side, even if provisions are going up. So maybe they're just building a buffer, especially since, as we mentioned, they're growing the retail segment quite quickly.
So in other words, time will tell, and we should just monitor it really well. But right now, still okay.
Yeah.
So I was looking at the share price performance of the banks that you cover, and I noticed that the big three banks, BDO, BPI, and Metro Bank, were sold down sharply. So what do you think is the reason for this?
Yeah. So for the big three banks in particular, I think that, of course, the earnings disappointment this quarter has had a hand in their, I guess, lackluster share price performance as of late. And then another part of that may also be that, of course, the market is pricing in the central bank's rate cuts, which maybe 2 or 3 took place in between first and second quarter earnings results.
Yeah, and I think probably also a more dovish Fed, which may prompt another rate cut going forward. So, yeah. I mean, are the big banks actually more vulnerable to lower margins because of falling interest rates?
I think that there's definitely some level of vulnerability. Like as much as they try to mitigate the downward pressure on NIM, they can if the market rate goes down, then the companies that they lend to will also demand prices lower. So there's only so much that they can manage and control. But then it does seem like they're doing a fair job at keeping their NIM as stable as possible.
Yeah, and it could also possibly be because the big banks, if I'm not mistaken, have a bigger exposure to checking accounts and savings account whose rates don't really
Change that much.
Go down or go up. They're just the same. So in a falling interest rate environment, it's still gonna be the same.
And less to benefit from in terms of on the time deposit cost side.
Yeah. So now it's the smaller banks that will benefit. Okay. So, but that said, so the big banks, which have been performing very well in the past, have gone down in price. I'm just curious if you think that now is a good time to start accumulating or, to take advantage of the share price weakness.
Well, I think that fundamentally the banks are still really strong. It's not like their earnings growth is negative or their margins have substantially been, I guess, compressed by the rate cut so far. So I think that for maybe a longer term investor, it would be a good chance to start looking at the banks now and accumulating these solid names really in among the stocks in the Philippines.
Yeah, while they're being sold down.
Yeah.
I mean, earlier on we talked about loan growth still healthy, plus NPLs not really going up, still quite steady. So I guess it is a good opportunity. in that perspective. Okay, so but that said, among the listed banks, which ones are your favorites right now?
Okay, so for my, I guess my top picks among the banks right now, first would be East West. East West is a smaller bank, but then I think that because of its heavy consumer focus, I think that it will be a huge beneficiary of the rate cuts that have come and maybe still coming in this year and next year. So I think that the earnings might be they might be the bank that continues to outperform the sector in terms of earnings for the rest of this year, like they have so far in the first half. And then apart from East West, maybe among the big three banks, I would choose Metro Bank. Well, BDO, BPI, and Metro Bank, since their share prices have come down, their valuations are really more attractive now. But then and all of their businesses are solid and they're all growing. The reason why I would choose Metro Bank to hold as a stock is more because it's paying out more dividends than the other two. So if you're going to start accumulating a big bank now that it's relatively, I guess, less in favor for the market, then I want to choose something that is paying me the weight.
Yeah. I'm just curious, like, what's the dividend yield of Metro Bank right now?
So for Metro Bank, I think around, well, I just checked a while ago. So as of around 70 pesos of the current price, if they are able to maintain that 5 peso, so maybe 1 point. It's like 2 peso special div, 3 the regular dividend. So if they can maintain 5, then I think it's 7%.
Which is quite high, and which makes it attractive in a falling interest rate environment.
Yeah, I forgot to mention, East West also has.
Yeah, so East West
also pays out dividends.
So what is the dividend yield for East West?
I'm not quite sure, but then maybe...
Is it like north of 4%?
Maybe 4 to 5?
Which is also attractive.
Its price has gone up recently, so...
Yeah, but still 4 to 5 is still a good dividend.
Yeah.
Okay, so with that, thank you very much, Charmaine, and thank you for sharing with us the reasons for, I guess, the weakness of the bank and that it's not really that worrisome because, as you've said, loan growth still there, NPL still steady despite their decision to set aside more provisions, which could be preemptive anyway, and margins still healthy, although there is some threat for it to go down. Okay.
Yeah, thank you for having me.
That's it for this episode of Market Talk series of Intelligent Investing. If you found this discussion useful, don't forget to like and subscribe for more market insights. And remember, stay sharp, stay selective, and as always, invest intelligently.